Hello, listeners, and welcome to the Credit Compass, the podcast that helps you chart your course through the world of European credit. I'm Gordon Kerr, your host on this new podcast here at KBRA. As we start 2025, I have migrated to a new role, focusing a little more on macro and a little less on the micro in European markets. My new podcast is meant to be a guide for navigating the complexities of European credit and capital markets. So sit back and listen as you join me on your commute, your walk to work, or however you listen. I am here to help you digest the latest developments in the financial world with clarity, insight, and the right amount of perspective from a credit lens. With Credit Compass, we're underscoring our commitment to providing insights and perspectives on the markets that help you stay informed and ahead of the curve. In this episode, we'll take a look at the key forces shaping the markets this week, from turbulence in the bond markets and foreign exchange to the ongoing ripple effects of tariff and political discussions in Europe. We'll explore how the new year is testing the resilience of financial institutions, markets, and policy frameworks alike. I am also joined by my colleague Van Hesser in this inaugural episode to help unpack some of the broader themes impacting the global environment.
Thanks for having me on, Gordon. Great to be here.
Underlying this, we will also tackle the topic of the past several years, inflation, a word we thought would have died in 2024, but has since been ringing louder and louder in the ears of policymakers at the European Central Bank and the Bank of England, and the Federal Reserve, of course. Finally, we'll zoom out to consider two major global events on the horizon: the upcoming inauguration of President-elect Donald Trump and the World Economic Forum in Davos. There's a lot to unpack, so let's dive in. As the year began, Europe's markets were impacted by a minor tariff tantrum. An article emerged suggesting that the tariff threats to Europe from the United States were to be more muted and broader based than originally thought. European markets reacted positively, only to correct back on Donald Trump's statement that the news article was inaccurate. All a minor blip in the end, but we highlight this as a potential foreshadowing of what we can expect in 2025. Including what we have experienced already last week: volatility on the back of uncertainty from the incoming U.S. administration. As Europe is currently struggling with low levels of growth at the moment, the impact of tariffs would curtail hope of a recovery in 2025. The sectors Europe has the greatest exposure in net trade to with the U.S. are the automotive, pharmaceutical, machinery, and energy sectors. These could all be impacted by an increase in tariffs. The automotive sector is already struggling in Europe, with job cuts in Germany and the struggle to meet regulatory demands on low-emission vehicles. Over the recent quarters, European and UK markets have underperformed the US exceptionalism, both in market terms and in economic ones. We expect this differentiation to continue, at least in the first quarter. This differentiation comes both in terms of the performance of Europe and the UK versus the US, as well as within Europe, as the UK faces a challenging first quarter alongside Germany and France, with others showing more positive signs, such as Ireland, Spain, and even Italy. Now, focusing on the troubles in the UK, the markets here had a rough week with sharp movements in both foreign exchange rates and bond yields. This was not a UK-only phenomenon, as yields in the US and Europe also went up. However, the UK was more heavily impacted, especially given the concerns about the risk of another moment like that experienced under Liz Truss when her government tried to implement an unfunded budget. Last week, the pound slid against the dollar and the euro, while UK government bonds, or gilts, faced pressure from the bond vigilantes that see inflated government debt burdens and a lack of central bank purchases offering a backbone to the market. The result has been a widening in yields. Van, maybe you can weigh in here. What do you see as the reasons behind this global migration in rates? I mean, are we just moving back to long-term historical norms? Or are we heading for a potentially stagflationary environment? The backdrop of consumer and business health is more positive in the US, but it's not exactly disastrous here in Europe.
Yeah, I would agree, Gordon. Rates have become unmoored around the world, we think, for probably a number of reasons. One, inflation is proving to be stickier than central bankers would like. Secondly, investors are increasingly anxious, it seems, about deteriorating fiscal situations, and nationalistic political regimes have been far less mindful of budgetary constraints seemingly, than their predecessors. And thirdly, probably in a related matter, sovereign debt issuance has soared, putting pressure on the investor base. This at a time when one of the largest sovereign debt buyers, governments, have pulled back as part of their quantitative tightening programs. I'm less concerned that stagflation will result, at least in the US. Rates tend to self-correct, albeit with a little help from their central bank friends. Once growth slows, labor markets and wage pressure weaken, and rates drift lower. And finally, I think it's important not to overstate the impact of higher rates in terms of their absolute levels. After all, the absolute level of rates here is not all that alarming, but the trend clearly at this moment is not our friend.
Agreed. One factor that has supported the rise in rates is the data out last week from Europe suggesting that inflation is again proving stickier than originally expected. Back at the start of 2024, everyone thought we would have had inflation tamed and rates would be back to normal. I say normal, meaning recent history. However, inflation is tamer, and we are still struggling with that last mile. When you're listening to this, UK inflation data will have been recently released. Expectations are for 2.6% in the latest iteration. And no matter whether the actual is actually higher or lower, it's still above the target range of 2%. The same is true of Europe. Expectations are for 2.4% on Friday, with some countries remaining above target and others well below. This is both a good and a bad thing. It is a good thing as it means that we are not tipping into recession, but it is a bad thing as rates are then likely to remain higher for longer, and as a result, curtail growth and continue to impact those more levered borrowers and lower income households. So let's now take a look at what is coming up in the next week. We have the inauguration of Donald Trump on Monday, the 20th of January, as the 47th president of the United States. People will be paying close attention to what he has to say, as well as what he and his administration start to outline for his first 100 days in office. This is regularly viewed as the most crucial in any president's term of office. On the one hand, this should provide the market with greater clarity. If there's one thing markets do not like, it is uncertainty. However, on the other hand, this is not a typical presidential character, and Donald Trump is often one for playing on uncertainty to ensure he holds the opposition, in our case Europe, on the back foot. Van, what are your thoughts on what we can expect to see out of the first week of Trump's term? For example, does he question Powell and his rate policy?
Well, Gordon, I think the only thing we can say with certainty about the impending launch of Trump 47 is that it will not be without bombast. Right? Remember, the first go-around gave us American carnage, if you remember that inaugural address. So we'll hear about Greenland and Panama Canal and all the countries that have taken jobs away from Americans for sure. His economic messaging this go-around, however, has been more cohesive, so expect to hear more about tariffs and immigration and tax cuts. And yes, I suspect it won't take long for Trump to criticize Fed Chair Powell for leaving rates too high. Now, interestingly, I podcasted back in December that markets I thought had reached quote-unquote peak Trump. Well, sure enough, stocks in the US had given back all of the post-election gains. Still, one thing is clear. Donald Trump will inherit a fairly strong economy.
Thanks, Van. Following quickly on the heels of the Trump inauguration is the Davos Summit. Davos is a small town in Switzerland that is famous for hosting an annual event put on by the World Economic Forum. Each year, the meeting hosts heads of government, international organizations, both big and small, entrepreneurs, society leaders, and more. It is a good opportunity to get a gauge on what influential individuals and companies think about and expectations for the year ahead. If I were to predict what the majority would say, it is that they are positive on moderate growth for the year ahead on aggregate. However, with notes of caution on growth for Europe, further, a changing of the competitive global landscape under the incoming US administration is likely to drive some degree of lobbying and discussion around potential deregulation, or at a minimum to stop further regulation in order to support growth, particularly in Europe. Lastly, there will be plenty of discussion around AI and what AI can do to help support growth globally. That's it for this week's episode of Credit Compass. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And if you have questions or topics you'd like us to cover in future episodes, please drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the credit compass help guide your way.